what's happening with Australia's economy? Well, let's delve into that. Australia's economy, like a kangaroo in a boxing ring, is currently experiencing a couple of significant jabs. First up, we have the soaring house price inflation. Australia's housing market, once as hot as a summer barbecue, is now showing signs of cooling. Thanks to the Reserve Bank of Australia's stimulus measures, including record low interest rates, the housing market has boomed. But this boom has made homes unaffordable for many. The average growth in home prices is projected to slow to 6% next year, down from an estimated 18% this year, and the pace of appreciation is expected to further slow to 2% in 2023 and 2024. Some analysts predict falling house prices in 2023, with a potential correction of around 10%. So buckle up, because the housing market ride might get a bit bumpy. Next, we have the drastic raises in inflation forecasts. The Reserve Bank of Australia has revised its inflation forecasts significantly higher, indicating that interest rates may need to rise to address the country's cost of living crisis. The bank now predicts that core inflation could reach 4.6% by December, well above its target band of 2 to 3%. As a result, the Reserve Bank raised interest rates by 25 basis points to 0.35% and signaled more rate hikes in the future. This rise in borrowing costs has implications for the average Australian, especially those with high levels of mortgage debt. These two significant jabs have thrown the overall economic landscape into a bit of a spin. On one hand, we have a housing market that's showing signs of slowing down, and on the other, we have inflation forecasts that are soaring higher than an Aussie cricket ball. This combination is creating an interesting, if somewhat challenging, economic environment. But what does this mean for the average Australian? Well, that's a good question. And to answer that, we're going to need to dive a little deeper into the housing market dilemma, the inflation and interest rates challenge, and the borrower's predicament. So stick around as we journey through Australia's economic landscape. First, let's delve into the housing market. In recent years, Australia has seen a housing boom unlike any other. The Reserve Bank of Australia has been pumping stimulus measures into the economy, and these measures have had a significant impact on the real estate sector. Record low interest rates have fueled this boom, creating a surge in demand for homes. But while this might seem like a positive trend, it's led to a concerning side effect. Homes have become unaffordable for many. Now, let's talk numbers. Average growth in home prices, which was at a staggering 18% this year, is projected to slow to 6% next year. And it doesn't stop there. The pace of appreciation is expected to further decelerate to 2% in the years 2023 and 2024. Some analysts even predict a potential correction of around 10%, leading to falling house prices in 2023. But why is this happening? Well, there are a few factors at play. One of the biggest is the potential for higher interest rates or tighter monetary policy. These could significantly impact house prices in the coming years. Affordability, or rather the lack thereof, is another major issue. For first-time home buyers, prices seem to be constantly moving out of reach, creating a growing concern. But it's not just about the buyers. Homeowners could also feel the pinch if house prices start to fall. Many have invested their life savings into their homes, and a decrease in value could have serious financial implications. So, what's causing this slowdown, and what could it mean for homeowners and potential buyers? Now, let's turn our attention to the issue of inflation and interest rates. The Reserve Bank of Australia, or the RBA, has revised its inflation forecasts significantly upwards. The RBA now predicts that core inflation could reach 4.6% by December, a figure well above its target band of 2 to 3%. In response to this uptick in inflation, the RBA has had to raise interest rates. Now, raising interest rates is not a decision taken lightly. It's a double-edged sword. On one hand, it helps to cool down inflation by making borrowing more expensive, thus reducing spending. On the other hand, it increases the cost of living for everyone, especially for those with loans and mortgages. This inflation and consequent rise in interest rates have implications for unemployment and wage increases as well. The RBA forecast a drop in unemployment to 3.6% and an increase in wages. This is because as inflation rises, employers often need to increase wages to maintain their employees' standard of living. But it's not just about the economic numbers. This rise in borrowing costs also has political implications. It might affect the election campaign of Prime Minister Scott Morrison. Rising costs of living and increased interest rates are not exactly popular moves among voters. It's a delicate balancing act for any government to manage inflation and economic growth, while also ensuring the public's well-being. Interestingly, the RBA believes that consumers can withstand these higher rates due to the savings built up during the pandemic. And despite these challenges, the central bank forecasts a healthy economic growth rate of 4.2% this year, slowing to 2% in 2023. In the world of economics, uncertainties are always around the corner. New coronavirus variants, global supply bottlenecks, and conflicts like the one in Ukraine can all have a significant impact on these forecasts. But how will these changes impact households with high levels of mortgage debt? Let's now take a closer look at the borrower's predicament. The rise in borrowing costs spells out an imminent challenge for households, particularly those already grappling with high levels of mortgage debt. As interest rates begin to climb, the cost of servicing these debts also escalates. This scenario is especially worrisome considering Australia's record low interest rates have fueled an unprecedented housing boom. For many, the dream of home ownership swiftly turned into a nightmare of unmanageable debt. Now imagine you're a homeowner. You've seen your house's value skyrocket in the past few years, fueled by the low interest rates. Your mortgage repayments were manageable, but suddenly interest rates start to rise. Each quarter-point hike translates into hundreds of dollars added to your annual mortgage repayments. You start to feel the pinch, you tighten your belt, but the rates keep climbing. Before you know it, you're in over your head. This isn't just a hypothetical scenario, it's a reality many Australians are facing today. And the implications are far-reaching. A high level of household debt, coupled with rising interest rates, could trigger a housing market crash, a catastrophe that would send shockwaves through the entire economy. The Reserve Bank of Australia's recent increase in borrowing costs is a double-edged sword. On one hand, it's a necessary step to rein in inflation and stabilize the economy. On the other hand, it could negatively impact housing activity and economic growth. It's a tightrope walk, a delicate balance between controlling inflation and not pushing households into a corner. The potential for a housing market crash is a real concern. Australia's housing market is one of the least affordable globally, and it's been over a decade since the last interest rate hike. The memory of the financial crisis is still fresh in many minds, a stark reminder of how quickly things can unravel when debt levels soar and the housing bubble bursts. So, where does this leave the borrowers? The future may seem uncertain, but one thing is clear. The days of cheap loans and skyrocketing house prices are behind us. As the dust settles, borrowers will need to navigate this new landscape, armed with the knowledge that the decisions they make today will shape their financial future. Finally, what's the outlook for Australia's economy? The Reserve Bank of Australia, the country's central bank, forecasts a healthy economic growth rate of 4.2% this year. However, this pace is expected to slow to 2% in 2023. This slowdown reflects the potential challenges that lie ahead, and there's no shortage of them. Firstly, new coronavirus variants remain a wild card. We've seen how these microscopic invaders can upend economies in the blink of an eye. They can disrupt supply chains, halt tourism, and dampen consumer confidence, all of which could put a dent in Australia's economic growth. Secondly, there's the conflict in Ukraine. While Australia may be geographically distant, it's not immune to the economic shockwaves. The conflict could lead to higher energy prices and increased market volatility, adding more headwinds to Australia's economic outlook. Then there are the global supply bottlenecks. These have been a persistent headache for economies worldwide, leading to higher prices and slower delivery times. For Australia, an export-oriented economy, these bottlenecks could weigh on trade and economic growth. And let's not forget about the households. With inflation on the rise and interest rates following suit, how will they respond? Will they cut back on spending, adding another drag to the economy? Or will the savings they've built up during the pandemic provide a buffer? And then there's the housing market. With house prices soaring out of reach for many, there's a growing consensus that a substantial decline in prices is needed to restore affordability. Some are even suggesting a 40% fall. This could have a significant impact on the economy, given the central role housing plays in Australia's economic health. While the future remains uncertain, one thing is clear. Australia's economy is at a pivotal point, and the decisions made now will shape the country's economic landscape for years to come.